Thank you for joining us today, everyone, for episode 2 of our webinar series, Connecting with EnerConnex. I'm Erin McAfee. I head up our marketing department here at EnerConnex. And today for our Market Intel webinar, we're going to be providing an energy market update, as well as have some folks from our team review their strategies and thoughts on navigating current energy markets. I'm sure you're all aware that markets have been pretty volatile as of late, to say the least. So I hope that you find this information valuable. So without further ado, I'm going to hand this off to Tom Dufresne from our team. Tom is a senior account executive here at EnerConnex and has more than 12 years of industry experience. So Tom, it is all yours.
Tom, you muted, I
I think you're on mute.
Sorry, of course I am. Good morning, everybody. My name is Tom Dufresne. Thank you for joining us this morning to review our Market Intel webinar. I'm going to start off with looking at key market indicators, or what I like to call your basic fundamentals of the energy markets. And when we look at basic fundamentals of energy markets, electricity, natural gas, you look at supply and you look at demand, right? Those are your key indicators, key drivers of the cost of electricity and natural gas. And as Erin mentioned, we're all experiencing unprecedented times in terms of electricity and natural gas costs. We have seen significant increases in costs across the board for a variety of reasons, both domestically and internationally on a global geopolitical scale. So first, when we look at energy markets, we look at natural gas supply, and currently natural gas supply is solid. We're at roughly 5% higher in production than last year. So it's interesting because we look at that as a bearish market, but if we look at the other fundamentals or indicators or market indicators, natural gas demand, even though it's down slightly from previous weeks, has increased significantly, especially from the time we were in the pandemic and the economy was shut down. So demand has increased since then and has been relatively consistent across the board, especially now this summer that we have been experiencing some historic heat waves across the nation, actually globally. So in terms of natural gas demand, we look at the market as bullish currently. And when I mean bearish or bullish, natural gas demand is bullish because it's adding upward pressure on the market. So it's increasing the cost of the commodity rather than adding a downward pressure to the markets, where we would call that a bearish market. So what's interesting right now, and what's actually concerning right now, is our natural gas storage, which each week we have seen a relative shortfall in natural gas storage. And you look at supply and we say, all right, well, we have supply that's 5% higher than last year. Well, that's gas coming out of the ground, which then is being used quickly to generate electricity and then also provide natural gas, the commodity, for manufacturing other demand. But what's happening is we are not putting or not injecting the amount of natural gas we have historically into storage. So as you can see here with the storage report back in July of 2020, that's when we were experiencing the pandemic. We saw a huge decrease in natural gas demand for both electricity generation and manufacturing, heating and cooling and the like. And we saw a significant increase in natural gas supply and storage, not just supply, but in storage. But as we saw the economy open up, that surplus of gas quickly normalized. And we see that through, October, well, let's say December of 2020 through to October of 21 into the new year of 22, that's a normal graphical representation of our natural gas storage over the years. And we've been tracking natural gas storage since 2017. And pretty much that's what the type of representation we have seen in storage since then, besides the anomaly in 2020 where we saw a surplus. But as you can see now, we are pulling away quickly from the 5-year average. So we are significantly below the 5-year average, which is the middle line there. The blue line, sorry, is the storage, the current storage numbers. And we're pulling away from the 5-year average during a time where we're smack dab in the middle of a national and global heat wave. So there's a demand for natural gas for generation to meet with demand. And because of that, we're not able to put as much gas into storage, and we're now moving into the fall and winter months at a significant deficit in natural gas storage. So if we move into, and which is concerning, because if we're moving into the winter at a significant deficit in natural gas storage, we're now going to be entering the highest natural gas demand season in December, January, February, March at well below 5-year averages, and then which will add upward market pressure moving into the spring of 23 and mid 23. If we can go back to the fundamentals, weather is another huge driver in the energy markets, specifically with prompt months. We have seen, over the last several days, a increase in natural gas. The markets have increased, for prompt month, anywhere between 10 to 30 cents, I believe, over the last week. And we have seen some daily increases. And that's to meet the demand for electricity during these heat waves. But the forecast right now, we're expected to continue to see historic and extremely high temps in the Northeast. Texas has seen historic heat waves, the Midwest, and it looks like August will probably end as one of the hottest months on record for some states and some geographic locations. So weather forecasts drive short-term energy markets, and weather forecasts right now are creating a bullish market, which is adding upward market pressure, and which will increase energy prices, electricity, and natural gas. And we also have geopolitical fundamentals as well in the market that do affect us domestically, right? So we have the war in the Ukraine. We have an increased need of LNG to the European Union. We've seen some decreases in exports to Mexico, but we may see even a greater need for additional exports throughout Asia. And that will add some upward pressure in a bullish market as LNG is increased for export, which now takes natural gas out of the United States, and we become, again, a net exporter of natural gas. So there are a lot of moving parts in the electricity and natural gas markets. And before I pass it along, we mentioned natural gas here over and over again, and that's because natural gas is one of our main drivers of energy prices, electricity, especially in the Northeast, because natural gas makes up well over 40% of our generation fuel. So as natural gas markets move, increase, decrease, typically that's how we will see electricity also increase and decrease. So Moving forward, you'll see that in the presentation following mine in terms of the various markets in PJM and in New England. So those are the fundamentals, and it all comes down to ultimately supply and demand.
Thank you, Tom. This is Kyle Mason here with EnerConnex. I'm going to walk through a couple slides, hopefully try and contextualize a little bit what Tom anecdotally walked us through with the bull and bear fundamentals and the situation currently with natural gas storage. So this chart shows you the historical values of Henry Hub natural gas prompt month settlement. At any given point in time, the forward calendar month is known as the prompt month. So right now we'd be looking at September 2022 forward natural gas prices as the prompt. This shows where those historical monthly values have settled at expiration. Not to get too much into the nitty gritty with the prices, but you can see historically they've settled somewhere in the $2 to $4 per decatherm range. The blue bars that you see spiking out are the 2022 settlement values. And you can see starting particularly in February of 2022, we've seen essentially a 7-month-long sustained trend where settlements have closed, in most cases at least twice, and in some cases 3 times as high as those historical averages. So this just puts, some data and numbers in a perspective to back up what Tom has been saying. So this next slide looks at, it's labeled a 5+ year history. We're actually going on 7 years now. It's a historical look back to January 2015 of the Henry Hub forward 12 and 24 month pricing. So the last slide was looking at the forward 1 month. This is looking at the forward 12 and 24 month strips. We experienced a very favorable run of nearly 5 years where gas prices traded between a floor of essentially $2.50 a decatherm and a ceiling of about $3.50 a decatherm. And as Tom touched on, over the last 12 months, we've seen an extreme run up in these gas prices, particularly this year in the last 6 to 9 months. We have a significant imbalance going on between the gas supply and gas demand. It's been exacerbated over the last few months with extreme warm temperatures across the country. The global economics with Russia invading Ukraine, the subsequent sanctions, it's thrown off sort of the global supply of natural gas and oil. And that's kind of the situation that we find ourselves in now. But if you go to the next slide, Aaron, I wanted to zoom out a little bit. If you've been in this industry long enough, not everybody has, but I wanted to illustrate that the current environment, although it feels unprecedented, it historically is not. We're actually just approaching what used to be the old normal prior to the financial crisis of 2007, 2008. So you can see dating all the way back to January 2006, we're looking at the same 12 and 24 month strips for gas, trading somewhere in the $7 to $10 range. And then we had the financial crisis in 2008 that spiked prices to really unprecedented levels. And then in 2005, beginning in 2005, but really coming to fruition in 2008, coinciding with that large drop off in the market, we saw commodity prices drop due to sort of the emergence of the Marcellus Shale, a large sedimentary rock that is located primarily in the PJM confines. And the second reason being an emerging technology called hydraulic fracturing or fracking. Essentially, those two combined to create a brand new domestic source of natural gas. It flooded the market with abundant supply, caused a steep decline in natural gas pricing. So a quick history lesson there, but I did just want to illustrate that if you zoom out and look back far enough, what feels like unprecedented prices in the current environment, it puts it into perspective a little bit and gives pause to the thoughts that we have nowhere to go but down back to normal. So there's a possibility that this is sort of the current new landscape that we're dealing with until we experience a much larger change in the market dynamics. So to transition from Henry Hub gas prices over to power prices, I'm going to actually turn it over to Vitana to take it from here.
Sounds good. Thank you, Kyle. Hello, everyone. Vitana Melishute here. I'm on operations team with EnerConnex. And actually, I've been in the industry since 2000. So I've seen the peaks, of 2000, what we saw in natural gas in 2008. But the slide I'm starting with is going to be the PJM and the Henry Hub pricing. Goal is to show you the correlation between the commodities. So if you look at the blue line, actually the orange line represents natural gas strip. So we're showing just a little bit shorter period of the graph that Kyle showed you earlier. And we added on top PJM West 12-month strip as well. 12-month strip, we kind of tracking the rolling pricing. So at the moment, we're tracking 12-month strip starting with September start date, looking 12-month forward. You can see the correlation that electricity is following natural gas. And the reason I think Tom touched on that is the primary generation resource is actually natural gas. Depending on the region, whether we are in PJM or New England, that percentage might be different. For a very long time, coal was the primary source of generation, but natural gas already surpassed in PJM. That's why you can see the pricing kind of coming very closely. On this particular graph, we're showing numbers from 2015, and you can see that, for example, electricity was trading somewhere in the range of $40 to $50 per megawatt hour. And now we're looking, the pricing reached, $120 and kind of dropped to the range of 80. Easy way to think about it is the wholesale prices were trading somewhere in the range of 3 to 4 cents per kWh. And this is just the energy component, for the when we kind of looking at the schema of the retail price, we have to add, additional components, but we have this axis of tracking the wholesale pricing for various zones. It kind of gives us indication where the energy is trending and how it's moving. So you can see that the pricing pretty much double what we've seen over the number of years, and it's been extremely volatile over the past 12 to 18 months. In addition to just kind of showing you the 12-month strip, we also want to bring up on the next slide, we have actually calendar strips, and different colors represent calendar strip for 2022 going out to 2026. You don't see the differentiation, here very much from, kind of showing from 2020 between the strips, but look at what happened starting 2021. And we call this backwardation of the market, where the front year strip is more expensive than the year, in the future. And it's usually caused by uncertainty and volatility in the market. Under normal market conditions, usually you pay a little bit more for the longer term contract, and we've seen that over the years. But right now, a ton of factors are impacting, the storage, the weather, the political events, and we see this huge volatility especially in the first 12 and 24 months. So if you look at the delta between pricing, yes, the market is extremely expensive now. If you're looking at a near-term contract, the 12, 24-month term. But for customers that have been proactive and been working with our team and they put contracts in place, we still have very favorable conditions, for the market going out. If we look at 2024, 25, and 26, calendar year strips, the market is more and more reasonable. The concern is that if we wait and see what happens basically you'd say, okay, I want to wait because the market is crazy right now and it looks more normal in the future. The concern is that if we wait, usually near-term market is impacted by the storage, by the weather. So, there's always the concern and risk of waiting longer to figure out what the next step would be for you to contract. But again, we kind of show this a little bit of normal market situation where the longer term agreements are cheaper than the near term agreements.
And Tanya, if I could add to that,
sure.
Kind of what we've actually seen in the market. So this trend has been holding for, let's say, the last eight months or so, or 8 to 12 months or so, where we have seen 2022 strips and 2023 strips relatively high, with that backwardation 24 through 26. But what has been interesting is that as we've been getting closer to 23, prompt month or short-term markets are starting to actually affect some of our 2024 pricing. So we have run events where for 2024 that are still very favorable, but we have seen increases in current markets, and they have then turned and affected those future markets by, let's say, a couple tenths of a penny, or 1/10 to 3/10 of a penny. So we're actually starting to see some current market volatility affect early 2024 start prices. As we've seen 20-30 cent increases in gas, we're starting to see some of that ripple effect out into the future, where we didn't really see as much as that ripple effect 6 months ago in those backwardated markets, but we're starting to see those as we get closer to the end of this year into 2023. So we're starting to feel it a little bit. It's not as pronounced as a contract that's starting in 23, but we're still, regardless, starting to feel some of that volatility out in those future markets.
Absolutely, Tom. Thanks for the points. On the slide 9, we understand that not all our customers are in PJM, and EnerConnex is actually covering every single market, whether it's New England, Midwest, ISO, California. So we are we a consultant that cover every single deregulated market for electricity, natural gas. For comparison purposes, we also wanted to show you, this is just a 12-month strip for New England, Mass Hub, and also Henry Hub. And the point here is that New England market is actually the most expensive market in US. And if we were looking at the PJM prices, I think the max was reaching $120. Look where Mass Hub actually 12-month strip almost reached $160 per megawatt hour, which would be 16 cents energy only, not even included all other components. And this is something that I'm going to touch on the other slide, where when thinking about retail pricing, when most of our customers, are retail customers and they contracting retail price. So this is the energy only component, and it has been growing significantly. So the slide I wanted to spend a minute, this is something that Kyle prepared for us, is basically showing the generation pricing components. And we're showing for comparison PJM, Pennsylvania, Jersey, Maryland, RTO, and also New England as well. So when we track pricing, for the energy, we know that there are also additional components, and we listing the components. I hope you can see it pretty well here, but obviously energy is the largest component. It's ranging somewhere between 70 to almost 80% in New England, but we also have capacity, we have transmission, we have renewables, we have ancillaries. So, we can monitor the market, monitor where the energy costs. We can, do hedges. We can, lock energy 100%. We can lock in energy at 50, 25%. But suppliers also will have to include capacity, transmission, ancillaries, and renewables. The two components I want to touch base on, and we have additional slides, is actually capacity and transmission. Both applicable in PJM. In New England ISO, capacity is applicable on the on the supply side. Transmission is being handled by the utility, but these components are driven by the peak demand. So when the grid is peaking, your demand, your usage actually matters. And if there is a possibility for customers to monitor their demand, they can reduce the cost of capacity transmission that they're going to be paying. So in PJM, it's roughly 17%. If we're looking at capacity and transmission, probably roughly 17% of the cost is those two demand components. And in New England is, we have roughly about 11% of the capacity. So this is something we want to keep in mind, that, when we look at the graphs, we also, have additional costs that we keep in mind. And renewables, one component that kind of grows each year, with the requirements by the PUC, Public Utility Commission, the greening initiatives. Utilities are, trying to add additional requirements for green generation that customers have to buy, even if they don't request additional renewable component. Utilities are forcing, suppliers and utilities also building into their rates. I remember that particular component used to be about 2%. Now we're at 7%, and I know going into the future, the renewable cost is going to be increasing as well.
Vitana, if you don't mind, I'll just jump in for a second before you transition off of the slide. So the right-hand side for New England ISO, I just want to emphasize that Massachusetts, if you're a customer in that state, they are, I believe, the second or third greenest state across the country. So they have some additional green and clean energy programs that are not listed here because they're not applicable to all New England states. So I just wanted to point out that there's a little bit of a difference between pricing components from when you look at Massachusetts and the rest of New England.
Yep. And
go ahead. Sorry, Vitana, if I could add as well, just with some of these other components like transmission and capacity, and this is for a different discussion, but just want to let the group know that you are able to address capacity and transmission by reducing your consumption during the highest demand days of the year, typically summer months. So if you're looking to manage those costs or reduce those costs, please reach out to us and we can have those conversations. We do that through demand response. We do that through some other consultative approaches. So it is something you can reduce in terms of cost. And if you are a large end user, reducing your capacity can equal a significant savings in future energy contracts. So please reach out to us with any questions as to how you can attack your capacity and transmission costs.
I know we approaching the end of the presentation, the scheduled half hour for today, but the slide that Aaron will send out actually will include pricing for capacity for PJM. It will include pricing for capacity and also for transmission. Just really quickly, if you look at the PJM prices, we're showing for a few zones. One thing to note here, that the light blue bar is actually represents capacity that was just announced probably like a month ago or so for the next planning year. Capacity prices are set for 1 year at that capacity auction. So the light blue represents pricing for the next planning year from June 2023 to 24. If you've seen historically, the capacity prices have been quite a bit higher. We're going to see some relief, even though the energy prices obviously went up significantly. We're going to see some relief on the capacity charge. And that's a positive for the customers. And I would say the biggest reason is what capacity reflects is availability of generation in your particular region. So back in, if you look historically, 17, 18, we had a bunch of coal plants retiring. New generation is being built, but it seems like especially the light green bar represents June 2022 capacity start, and then light blue June 23. So the capacity cost is going to be dropping down. Similar picture in New England. We have different zones here in the history. Once we distribute the slide, you can see it. But if we look at the 2022, 23, 24 capacity prices, those prices are going down, which is a good thing. A little bit different story with transmission. Transmission, it's the grid is being kind of getting old, and investments are needed into the grid, and we're not expecting that transmission prices are going to be going down over time. And you can see kind of pretty much each zone from the few, we're tracking all the zones, but from the few zones that we're presenting here for the PJM, the cost is actually going up each year. And I think expectation that transmission cost is going to be kind of increasing. And just for comparison, for 1 megawatt, if your demand is 1 megawatt, like for example, in AEP zone, you would be paying $100,000 for that 1 megawatt of transmission. So if you can manage your demand and you can reduce that demand, so the cost would be lower for you. So I think that's the key, that's important. And our team can help you manage the energy cost and manage the demand cost as well. So your overall cost would be cheaper on future contracts. And I think just to wrap up, it's kind of quick summary of all the slides that we reviewed. We're looking at the significant increases in natural gas pricing, not the highest we've seen over the past 20 years or so, but definitely the highest in the past 14 years. And natural gas is the key contributor for electricity generation. And due to the uptick in natural gas pricing, we've seen in all the regions electricity pricing doubling, in some cases even more than it has been a year or a year and a half ago. Various factors are impacting pricing. The storage and weather are the short-term drivers that, our team is monitoring and going to be monitoring. It's going to be very interesting where the winter forecast is going to come in. I think that's going to be putting some pressure on pricing as well. And, I think the key point is a lot of our customers, trying to figure out, okay, what should I do? What the utility is offering, and suppliers are representing, and when they're giving us pricing, they're representing the current market conditions. If you look at the utility is lagging, utility is behind. So in some cases, utility rates could be temporarily lower than the market, but utility rates will be catching up. Utilities also have to buy power and natural gas and electricity in these market conditions. And we just see the delayed reflection on the utility rates at the moment. So again, this is where our team can help out. You understand, how the pricing, at what levels pricing is coming in, how it compares to the utility, what options you want to take a look, and whether you want to do, partial hedges, you want to monitor the market and kind of make a decision at a later date. Our team is ready to help out.
Great. So thank you everyone for joining. Thank you, Vitana. Thank you, Kyle. And thank you, Tom, for running through all this information today. As I think Kyle mentioned before, we send out a market intel report. I'm sure some of you receive it on a weekly basis. So if you ever want to review that with some of any of our team members, definitely reach out to us. And have a great day. We appreciate you taking the time out to join us today.